Alright, welcome back to Archi Lens. Today, we're gonna talk about one of the most expensive mistakes in real estate, and strangely, it has nothing to do with the property. One of the most expensive mistakes in real estate is buying a property you can afford, but you cannot survive, because those are not the same thing. And that's exactly where many investors get trapped. Right now, there are investors sitting in Dubai who bought a good property with a good developer in a good community and good location, and also good master plan, and yet they regret their decision. Not because the property failed, but because they couldn't survive the property. And that's a completely different problem. For example, there are two investors. They can buy the same exact property. And of course, same developer, same floor plan, same community, same market, and same timing as well. But 5 years later, one become wealthier, while the other become a prisoner of the investment. And here is exactly the dangerous part, that the difference was never the property, but the difference here was the buyer. Therefore, by the end of the video, I'm going to show you a framework that you can use effectively before buying any property. Not just in Dubai, and not just in today's market, but in any market, any country, and any cycle. Because I'm sure, as you notice, unfortunately, the market are full of noise. And for example, this is the last opportunity, or the prices will be doubled, or you can flip this property within very short period of time, or some says everything is selling in Dubai, or one of the craziest pitch that I used to hear in the market, which is first come, first serve. I don't know what was in their mind actually when they used to pitch buyers with first come, first serve in real estate. But anyway, most of that information, of course, is irrelative, because none of those answer the question that actually matters. Is this property compatible with me, or am I unknowingly buying a future stress? The hidden mistake that most of investors spend months in studying the property, but unfortunately almost nobody studies themselves. They evaluate the developer, the location, the payment plan, and the market, floor plan, community, views, amenity, facility, etc. But they never ask themselves this simple question, which is, can I survive this timeline? Can I survive uncertainty? Can I survive illiquidity? Can I survive pressure? And can I survive a market that doesn't cooperate with my plan? Because during expansion, everybody looks intelligent, since liquidity hides weaknesses, and momentum hides mistakes. And here the easy exit create fake convictions. And what's really dangerous, a lot of investors think they are long-term investors up until the market stops moving. And at that time, when the market stops moving, they discover they were only long-term investors as long as the prices were rising. Therefore, I realized something important, that most investors, they don't buy the wrong property, but in fact they buy a property that requires a different version of themselves. A version with more patience, more liquidity, and more resilience to market fluctuations, and of course more holding power. And unfortunately, when the reality arrives, the mismatch between the buyer and the property becomes visible. And of course, not all capital behaves the same, and that's why not all investors should own the same asset. And most of the investors fall into one of the three structures: the short term, mid term, and long term. And every structure has an asset that naturally fits it, and also every structure has an asset that naturally fights it. Let's start with the short term capital, or the short-term investors who think in 1 to 2 years, and even some of them think shorter than that. This kind of investors need liquidity, need also flexibility and optionality. But the problem is, many short-term investors buying long-term assets. They buy a 10 years asset with only 2 years mindset, or in other words, a 15 million dirham villa with a 2-year exit plan. And that, of course, is not a strategy. That's a structural gambling. Because if liquidity disappears, the entire plan here disappears with it. Now coming to the second structure, which is the midterm capital. Or in other words, midterm investors who thinks in average 3 to 5 years. And honestly, this is where a majority of the investors actually live. Not too aggressive and also not too conservative. Somewhere in the middle. And this structure provides the asset enough time and enough patience for the asset to actually work. And also enough flexibility to adapt. And in this structure, this is exactly where time starts to help the investors, instead of fighting them. Now coming to the third structure, which is the long-term capital. This structure featured by a strong liquidity, no forced exit, and cycle-based thinking. And in this structure, the investor doesn't need the market, which is exactly why the market works for them, because uncertainty here becomes survivable. And of course, survivability creates opportunity. Now coming to the framework, I wanted a way to measure something, not the property, but the compatibility between the property and the buyer. Because the more I look at investors, the more I realize something, which is many people, they weren't failing because they acquired a bad asset, but they were failing because they bought an asset that demand more patience, more liquidity, more resilience than they actually possessed. So I built what I call the buyer asset fit equation. And the goal here is simple, which is to measure whether this asset and this investor or this structure are compatible. And the equation looks like this. Buyer fit score equals 0.35 multiplied by the horizon time plus 0.25 multiplied by the cash flow strength plus 0.2 multiplied by the risk tolerance plus 0.2 multiplied by the objective clarity. Or in other words, T plus C plus R plus O, with of course different weights. And every variable is scored from 0 to 10. Now notice something important, that time carries the highest weight, which is 35%. Why? Because during difficult periods, liquidity can disappear, demand can disappear, momentum also can disappear, but time is the only variable that naturalizes pressure. Now let's define each variable. First, the time horizon, which means how long you can realistically hold the asset, not emotionally and not theoretically, but realistically. Now, the cash flow strength, which means can your financial position comfortably absorb the pressure, especially when the market slows. And risk tolerance means how well do you function during uncertainty? Do you remain rational or do you become reactive? And last but not least, objective clarity, which in other words, why are you acquiring the property? Is it for investment, capital preservation, end use, or income generation? Or are you simply following the momentum? And once we calculate the score, we place it on a scale. And that scale is from 0 to 4 structural mismatch, which means the asset is demanding more than the investors can comfortably provide. And then moving from 4 to 6, which is the caution zone. Here, yes, it is possible, but fragile. In other words, small changes in the market conditions can create significant stress. Now in the next zone, which is from 6 to 8, it is the functional fit. Here, yes, the asset and the investor are generally aligned. And lastly, from 8 to 10, this is strong alignment, which means the investors have the capacity to absorb uncertainty, delays, illiquidity, and market fluctuations. Let's run here a real example. Investor A, with a time horizon equal 3, cash strength equal 5, risk tolerance equal 4, objective clarity equal 8. Now when we plug in those numbers into the equation, we get 0.35 times 3 equal 1.05, and then 0.25 multiplied by 5, we get 1.25, then 0.2 multiplied by 4, we get 0.8, then 0.2 multiplied by 8, we get 1.6. And now when we add all the numbers together, we get 4.7, which means here the investor A scores 4.7. Therefore, according to the scale we just mentioned, here the investor A is in a caution zone. And here exactly where it gets interesting. Because this investor believes he's a long term, but his structure says otherwise. So in reality, every week he checks resale prices. Every month he asks if now is the right time to exit. That's why he's not investing, he's renting confidence from liquidity. Now let's take another example with investor B. Investor B has a time horizon equal 9, cash flow strength equal 8, risk tolerance equal 8, and objective clarity equal 9. Now when we plug in those numbers into the equation, we get 0.35 times 9 equal 3.15, 0.25 times 8 equal 2, and 0.2 times 8 equal 1.6, and lastly 0.2 times 9 equal 1.8. And when we add those numbers together, we get a total of 8.55. So according to the scale, investor B is in the strong alignment zone. And this is of course completely different structure. Therefore, correction do not break him. Delays do not break him. Illiquidity do not break him. Because investor B doesn't need certainty. He only needs time. Now look carefully at the difference between those two investors. It is not intelligence, it is not experience, it is not even the asset itself. But the main difference here is the structural compatibility. Here, one investor needs the market, while the other investor can wait for the market. And that big difference creates completely different outcome. Now let's, for example, imagine both investors, they acquired property in the Oasis by MR. The project itself hasn't changed. The developer doesn't change. And the market are same for both. And here, of course, the only variable that it changed, which is the buyer. Investor A become impatient, then emotional, then urgent. And unfortunately, in real estate, urgency is expensive because the premium buyer pool narrows. And of course, in the case of investor A, while he's impatient, he cannot wait for the right buyer. And of course, cannot wait for the right market. And in his situation, in his position, he needs actually any buyer just to exit. Now, on the other hand, investor B become patient, then selective, then of course, powerful, because his structure already assumed uncertainty. Now ask yourself one question. If the market stopped moving tomorrow and nothing changed for 18 months, what actually will break first? The market will break first, or your plan, or your patience? Because forced sellers do not fail because markets are bad, but they do fail because their structure was too fragile for the timeline they bought into. That's why a bad property can hurt a portfolio, but the wrong structure can unfortunately destroy a good property. And markets don't reveal your strategy. In fact, markets reveal your capacity. And markets reveal your capacity to wait, your capacity to absorb pressure, and of course, your capacity to survive uncertainty. And most investors, they do not buy the wrong property, but they buy a property that requires a different version of themselves. And it's a fact that markets do not reward excitement, but it rewards survivability. And survivability creates optionality. And of course, optionality creates wealth. And through Archi Lens, we don't chase the market. In fact, we decode the structure and position within it.